This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Interested in learning more about investing in startups, launching a new startup, and need to raise funding? The Startup Funding Espresso is a daily podcast in a short, concise format delivered to your inbox every day, Monday through Friday. In the time it takes to drink an espresso, you can learn about startup funding. To subscribe, go to investorconnect.org and put your email into the pop-up box. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Jim Denholm, founder and CEO at IronBridge Private Wealth. IronBridge Private Wealth was founded in Austin, Texas to combine the strength and resources of a large financial firm with the independence of a local company. They are true fiduciaries of their clients' wealth, having real risk management strategies that adapt to changing market conditions while understanding the client's individual goals and objectives. Provides the foundation of true fiduciary service. Jim, thank you for joining us.
Appreciate the invitation. Look forward to the discussion today.
Great. Well, let's kick off with what your background was before starting to invest in early stage companies. What did you do before this?
Well, we're we primarily at this point are actively managing liquid portfolios for clients in the public markets. I started IronBridge about 4 years ago. I was in big firms for quite a while, 15, 17 years prior to that. Actually, I have a mechanical engineering degree from UT. And, private investing has always been an interesting thing to learn about and to participate in. And being in big banks, we never really were able to do any of the more interesting type of things because the big bank compliance department. But as we've, kind of took my team and went independent, it's becoming more of the part of the discussions we're having with our clients, and it's been interesting to see kind of the explosion that's happened in the private market over the last 10 years or so.
Great. So what excites you right now?
I think there's some interesting things happening. One is simply increased access. For a long time, you basically either had to be a large institutional investor. You had to have some relationships with some of the bigger private equity funds. And there's just been a lot of smaller companies that are helping facilitate private investments. There's been more access for individual investors to be able to get direct participation in companies with, organizations like what you've created and trying to connect the investors with the companies themselves. So I think it's been real interesting to see the increased access that people have to this space over the last 10 years. And I think that's only going to increase over time as all the there's a lot of liquidity sloshing around in the economy and in the markets. And that's finding its way to interesting, smaller companies that people can invest in.
Well, great. Well, you work with investors in startups. What's your advice for people investing in startups? What do you tell them to do before they write that first check?
I think you have to have a thesis first. You kind of have to know what you're looking for. A lot of times, when I was starting to learn about it myself and started to, explore the private markets a little bit in more detail, there's so much out there. Once you really start to dig into what's available, you realize that there's a whole lot of different types of companies that you can invest in. And most of the time, there's some sort of finite window that you have to make a decision to write a check. It's not like you're buying the S&P 500 index fund that you can go and if you find an interesting opportunity, you can invest in it whenever you want. Typically these companies, when they're out trying to raise capital and, converting some of the owner equity into investor equity, they usually have a timeline. They usually have a specific project and a specific need for the funds to help with growth. So as an investor, you really need to sort of know what you're looking for and have some pretty disciplined filters so that you can recognize a deal that you might want to do some more due diligence on. And you can recognize a deal that's probably not going to fit what you want. And you can sort of make an early pass. You could waste a lot of time doing due diligence. But if you have some basic tenets of a thesis on what you're looking for, I think it makes it a lot easier to increase your likelihood of getting something that you're going to be both happy with and, ideally profitable. That's what we're doing this for, right? So I think it's having that parameters on what you're looking for.
Great. And so on the other side of that table, what's your advice for people running startups? What do you tell them to do before they go out to raise funding?
I'm a part of a private investor group where we get together once a month. We used to do in-person lunches, pre-COVID. I'm looking forward to doing that again, but we've seen quite a few pitches to our group, and you can tell the groups that are a little underprepared and maybe want capital, but don't necessarily have, well thought out plans either on how they want that capital structured, kind of viewing it from the investor standpoint. I think they often view it from the business standpoint of, if we can only raise $500,000, or if we could raise $1 million, our revenue would go up by X% and our company would be worth this. But you really have to understand that these are investors that have typically done this before. You're probably not dealing with a whole lot of first-time investors, and you need to structure the deal and structure the pitch with the investor in mind, not just the business in mind.
Great. Well, let's talk about the state of investing. How do you see the startup industry evolving from here?
I think there's a few things that could benefit the private investment market. One is we're in an environment where there is quite a lot of speculative fever out there. It's a little bit at the fringes more, with the various Bitcoin and cryptocurrencies, the dog coin now, which is, pretty fascinating. And frankly, somewhat ridiculous, depending on how on your viewpoint. There's a lot of different places to make money. And, with markets being in generally an uptrend over the last 12 years, last March excluded, there is a lot of liquidity out there. And I think that there's more and more of an attitude across the investor community and across society in general, kind of being a little disenfranchised and having more of a view that kind of the game is rigged. That was very much evident with the GameStop saga that happened a little bit earlier this year, a few months ago. And I think that kind of attitude has been growing over the last 20 or 30 years. And I don't think that attitude is going to change anytime soon. I think it's actually going to get enhanced. So I've noticed more and more people, especially younger clients that we're dealing with, a lot of the wealth that's created are from business ownership, and from the liquidity events that come with selling your business. And there is definitely a more of a skepticism towards the traditional investing approach. Very few people that I talk to right now with any kind of wealth associated with it just want a 60-40 portfolio. So I think we're going to see a continued appetite for private investments, a continued appetite for being able to know exactly what somebody is investing in, be able to know the management team, not just have a publicly traded stock that may or may not be doing something that's aligned with someone's individual values. So I think we're still in the very early stages. As mature as this space sometimes feels, I frankly think we're still kind of in the early stages of it.
Cool. Well, what do you think is the biggest change we'll see over, say, the next 5 years?
5-year time frame. I think it's going to be the next. I don't know if this is going to happen in 6 months or 2 years or 5 years or 10 years, but at some point we're going to go through a more protracted kind of negative environment in the public markets. That could be coinciding with more persistent inflationary environment, but I think we're going to be in an environment where public markets are simply not going to provide the returns that they have over, say, the last 10 years. And we could be in a very longer term, 10-year, 15-year period of flat or declining prices in the broad public markets. And I think that's going to further enhance people's kind of skepticism of the traditional investment portfolio and make even more people who have accumulated wealth and are looking to place it and start to get frustrated with mediocre returns, have their buy and hold strategy go from the public markets into the private markets. Having an increased combination of public plus private portfolios for more and more people, where you don't have to necessarily have a $50 million net worth to have 10 or 20% of your portfolio in the private markets. I think the access at smaller dollar amounts via more and more potentially funds, private equity funds that are available doing different things, I think is going to increase the liquidity in the private market area. It's going to increase startup owner and founders' access to capital. I think they're going to have more access to capital. And I think it's going to, more and more be away from, the traditional bigger banks to get their capital more and more towards private debt and equity investors.
Great. So you talked about the importance of an investment thesis. What is your investment thesis?
Well, our firm primarily deals in the public market, and there are kind of two main benefits of the public market. One is having access to very large companies and having access to companies that have registered their shares publicly. But the biggest benefit is liquidity. So our public market strategy is more of a trend and momentum strategy, where you can participate on, in shorter term trends, 6-month, 12-month, 24-month trends, and be kind of agnostic to the longer term trend. You can make a lot of money doing that. In the private markets, I think you have to look longer term and say, okay, where are we today? And where are we going to be 10 years from now? And where are we going to be 20 years from now? And to me, there's two big areas. I think, technology has been a focus. I think technology is going to continue to revolutionize multiple industries. So I think you have to, if you're thinking about private investments, it seems like technology it has been for the last 20 years. I think it will continue to be for the next 20 years, the primary place where you're going to be able to get really good exposure to individual companies as an investor. The other area I think that is really starting to emerge is sort of the intersection of technology and biology. So different, nanotechnology that may change how, what people's lifespans are. I think we're in an environment, one of Austin's newest residents, Elon Musk, Jeff Bezos, these people that have way more money than they know what to do with, I think are probably going to spend quite a bit of capital in trying to make themselves live longer. And I think there's a lot of different tales to that. So I think when we look over 10 and 20 years, I think there'll be some really fascinating things that come out of the intersection of technology and biology. And then on the flip side of it, I think it's almost a barbell. You have your, kind of what would be considered a little bit more boring, type of companies that, make stuff and deliver products and deliver goods. If we are going into an inflationary environment, which I do think we are, I think inflation is going to be creeping up. When it's not going to become runaway inflation all at once, but I do think that inflation pressures are building, and I do not think that they'll necessarily be transitory. There'll be some really good private companies that I think have nice pricing power that work in building and delivering stuff that would be, interesting as a complement to some of the more speculative technology and biotechnology areas.
Great. So what do you think are the biggest challenges you see your startups today face when they go out to run their business?
I mean, there's plenty. I think when it all comes down to consistency. I think you have to know what you do. You have to know your place in the market. When it comes to a startup that's looking to raise capital, I think one thing that people don't quite spend enough time on are what are the second and third and fourth transactions that might happen with the company. Not just this round of funding, but what's the second round after that? Where ultimately is the end goal? Are you going to try to get acquired by a strategic partner? Are you going to try to go public? Are you just trying to make it a lifestyle business and make money and do something that you love? But I think if more startups would think more strategically about kind of your, not this round of funding, but that secondary sale, the third sale, who are going to be those buyers? How do you position yourself right now? And you'll be way ahead of the game when you're trying to raise your first round.
And then on the other side of that table, what's the challenge the investor faces in this current environment?
I would say as much increased access as there is, there's still a matter of trying to find the right company to try to get access to the type of company that you want. The smaller you go in the private equity space, the more regionalized the opportunity set becomes. There's probably not a small company in Vancouver that you're going to get access to if you live in Austin, and vice versa. So I think it's understanding some of the geographical challenges to try to overcome. I think that in the future, I think we're starting to see those barriers start to get reduced a little bit. And I think they're going to be even further reduced as technology starts to open up opportunities.
Right. Well, you see a lot of different applications and sectors out there. You had to pick one or two that are good immediate opportunities for investors to pursue. What do you put at the top of the list?
Are we talking about a private equity investment or just in general?
Just in general, because you can find public and private companies on both sides of these technologies and spaces.
Yeah, like I say, I think you have to look at the time frame. If you're private equity investment, you're looking at 5 to 10 year commitment. So you have to think about that on a 5 to 10 year time frame and adjust your thought process accordingly. Obviously the broad markets have just skyrocketed from the COVID crash last year on the back of Fed printing money. Nobody can predict the markets. And, I've got a crystal ball, but it's covered in dust and dirt and it's under some dirty rags in the attic. So I don't think it would tell me anything if I could see it anyways, but there's a trending market right now that's pretty attractive. There's a lot of risk appetite. I think the overall environment reminds me of kind of 97, 98, which is when I started trading stocks. There is a lot of speculative fever out there, and that can be good for a lot of different risk assets. So, I think it's a matter of looking over a few months, broad markets look pretty attractive. Technology seems to be breaking higher. We've seen some more favorable trends in financials and energy. But I think if we're looking in the private space, I think you have to have some sort of technology disruption component as a big part of what somebody might be looking for.
Cool. Well, in the last few minutes that we have here, what else should we cover that we haven't?
I think the one thing for certain is that things change. And with doing any kind of investment strategy, I think you need to think about the optimistic things that can happen, but also the pessimistic things that can happen. I think as investors and entrepreneurs, we tend to be very optimistic, and we just want to, I think it's helpful to be a little bit more stoic and kind of see things as they exist and see the environment as it exists and see the markets as they exist, kind of not as we hope they are. And so, when you're placing funds from an investor standpoint, something can look really great. You can have a founder pitch their idea and they're very passionate about it, and it's easy to get caught up and get excited about it and place money. But I think you really have to start to look at both sides of it very, very, in a very, very disciplined way, so that you don't have surprises. I mean, investing is about eliminating surprises. And if you're not surprised with something, then you're probably doing something right. Even though we know everything won't work out. We hope that every investment that we make works out, but as we all know, it doesn't happen like that, does it?
No.
So I think making sure that you don't get caught up in a certain fever, you don't get caught up in the emotions of an environment, and you remain very disciplined and kind of stoic with your analysis.
Well, great. Well, how best for listeners to get back in touch with you?
A couple ways, Jim.Denholm at IronBridge360.com. Denholm is a great way. Just contact me directly. You can look at our website, IronBridge360.com, and look me up on Twitter. I'm one of the few Jim Denholms out there. So it's not a super common name, but it's at Denholm_Jim. So any of those ways are good to connect.
Great. We'll include those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Appreciate it very much.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.